Hi, I'm Tyler Ballhorn. Welcome to the Stockscores Market Minutes for December 3rd, 2012. This week's topic, risk on, risk off. I will get to that in just a moment. If you would like to see this video in full HD resolution, I encourage you to click on the small gear sign in the bottom right-hand corner of the video viewer. That will allow you to increase the resolution so you can see all of the detail in the charts that I have on screen. All right, let's get into this week's topic. Risk on, risk off is a way of describing how receptive the market is to trading. It's really an indication of whether traders are willing to take risk or whether they are stepping back and unwilling to buy stocks higher. The market runs in waves, alternating between trading is working and when it is difficult. When the market is working, trading is easy, and the profits come with relative ease. However, there are times when nothing seems to work. We need a way to differentiate between the two market conditions. How can we determine whether the market is receptive to trading or not? There are two factors that are important: the intraday trend and whether the market is above or below the open. Now, the intraday trend is a longer-term means of determining whether the market is receptive to trading, and we'll look at both now, beginning here with the chart of the S&P 500 over the last 60 days, and I've highlighted with red and green lines periods when the market was in risk-on mode, which is green, and risk-off mode, which is red. And you can see that it's basically drawing a short-term trend line across the lows, but doing so on the intraday chart. The market has become a lot faster these days, and to apply this analysis to a daily chart doesn't really work all that well. It's much better to just peer inside the daily chart, looking at the intraday chart, and try to determine whether the buyers are in control in the short term or if the sellers are in control. If there are falling tops, like we see in red, then the sellers are in control, and we can say that the market is in a risk-off state. When there's rising bottoms, like we have in green, the buyers are in control and we have a risk-on state. It's a lot easier to make money trading when we are in a risk-on mode. All right, let's get into a shorter-term way of looking at this, and this is really more for day traders, but is the market above or below its open? This chart goes back the last 2 weeks, and I've simply highlighted in green the periods when the market was trading above its open, and in red when the market was below its open. On those days when you are below the open, essentially the sellers are strong for that day. Now that could be in a longer term period of buyer optimism, but sometimes those days when the market is down and below its open, it's a little bit tough to trade. Now the market can be down, but if it is above its open, that means stocks are trending higher through the day. Okay, let's get into the analysis for this week. I've chosen to look at 60-day, 60-minute charts this week just to give you a shorter-term impression of what's going on in the market, because we're at a pretty critical point given how the market pulled back to its trend line today. In fact, looking here at the S&P 500, it could be argued that that upward trend line was broken. Notice that the tops were rising at a slower pace. I've identified that with the red line. The bottoms were also rising, that's the green line, but that green line was broken late today. So if we don't get a bounce back early tomorrow or sometime tomorrow, I am fearful that we are on the verge of the market going into risk-off mode. In other words, the sellers are going to be taking control of the market, and that should push stocks lower in the short term. All right, moving on to the next chart. This is a chart of the TSX, and you can see a similar situation in that we have that rising wedge pattern. The tops are not rising as quickly as the bottoms. We have not, however, broken the upward trend line here, so there is a little bit of a conflict because the S&P just tickling through that trend line, the Canadian's still above it. So it's not a real lock that the recent upward trend that's been underway for the last couple of weeks is over, but I do think we need to have some caution about the market right now. This is the Russell 2000 in an upward sloping channel, has pulled back to its trend line. It should bounce here. And again, this is also a little bit of confirmation that maybe the S&P 500 can bounce tomorrow and really hold that trend line even though it tickled through it today. Here we have the TLT, which is the treasuries, and in times when investors are going into risk-off mode, they tend to move into treasuries. You can see that we are below a downward trend line and recently broke an upward trend line on treasuries. So this tells me that money is not all that eager to rush back into safety just yet, and that is also supportive for stocks. So again, we may end up holding that upward trend line on the S&P tomorrow, something to watch out for really closely. US dollar is falling, and it's interesting that the market today was down, but also the US dollar was down. They tend to have a reverse correlation where the dollar falls, the US market goes up. Well, that didn't happen today, so that's a bit worrisome about that disconnect, but certainly a falling US dollar is supportive for stocks and commodities. Euro is higher. Of course, if the US dollar is going down, the euro would go up. Nice upward trend line, well in place. Coming into some resistance at about 130.5 there on the ETF. Something to keep an eye on, as it should get stuck at that price level. Gold is in a short-term pessimistic pattern. We've got some falling tops over the last 5 or 6 days, but unless that support line in the green is broken, I wouldn't be too worried about it, but it does seem to me that maybe money is coming out of gold. You would expect gold to be strong with the falling US dollar, and in fact it's not. So that tells me that money is not so eager to use gold as a safe haven. Oil rallied up to resistance at the red line, got stuck today. Yeah, I mean, it probably is going to, more than anything, just go sideways in here. I think that in the last 4 or 5 days it's a little bit overbought. Probably pulls back in the short term, but doesn't have a considerable amount of downside given the support on the chart. And finally, the fear index, the VXX, is breaking its short-term downward trend line, has lots of overhead resistance, but this is a bit worrisome because money is starting to buy those options which are protection against downside risk in the stock market, and the fact that this rose pretty strongly today is a bit of a concern for me, and I would keep an eye on this one. So we're at a real critical point for the market. I'm keeping my neutral rating on US stocks, Canadian stocks, and gold, but with the recognition that it's pretty risky right now because we are at or very near those trend lines, and one bad day could break that upward trend and we'll go into risk-off mode again. Oil, I'm bearish simply because it's hit resistance. Probably is going to come back in the short term, but I'm not considerably bearish, so I think more than anything, oil just stays in a trading range for the next little while. As I said, markets are right at that short-term trend line. Unless there is a bounce back Tuesday, switch to a risk-off outlook as a pullback is likely. Now, in that risk-off approach, you tend to want to short strength, not really chase strength. You can still buy the odd stock if you get in early enough so that your risk-reward ratios are good, but certainly don't chase stocks higher. Gold is building pessimism, and oil appears overbought in the short term. Well, that has been the Stockscores Market Minutes for December 3rd, 2012. Have a great week in the market and trade well.